What's going on, everyone? Welcome back. Patrick here, moving on to the next example, still dealing with double entry accounting. And as usual, this example here, it's written out in the lecture notes. You can print those out. They're at the beginning of the section on the website. And if you're on YouTube, you can go to the description box. There will be a link to the course website. And then on that website, you can find the lecture notes. So as we did with previous examples, notice that only the first transaction is written out here. There's a total of 13 in this particular example. And what's going to happen is as the video goes on, I'll bring in those other transactions and then show you how to deal with them. Now, in this particular example, we're going to go into a little bit more detail in terms of all of the accounts. So what's happening is this is a new business that you're starting. And we're going to go through all the transactions, and then at the end, we have to provide a detailed balance sheet and a detailed income statement for the month. So we're still going to be taking these transactions and inputting them into that equation that we did, that we used in previous examples. So we'll have that change in assets equals that change in liabilities plus that change in capital, plus that change in retained earnings, and then that is broken down into revenue minus expenses minus dividends. But now what we're going to do is for each of these inputs, we're going to state specifically what account is affected. So for example, let's say that we make revenue and we get paid in cash. Let's say we get $200. Well, I would put 200 here, but instead of just putting the 200, I'm going to put the specific account that's also going to be affected, which would be cash. Or let's say that we're buying supplies. So we would get supplies. Let's say we bought $100 worth of supplies. I would put plus 100 here, but instead of just having plus 100, I'm going to put the actual account that's affected. Right, so we'll go through each transactions and then I'll be introducing some accounts as well, just the terminology of them. And then what's going to happen is at the end, when we make our financial statements, in particular the balance sheet and the income statement, there's going to be a little bit more detail to it. So let's start off with the first transaction. So you're starting a home cleaning business with $3,000 of your own money plus an 8% $3,000 loan from the bank, and then interest is charged monthly. So starting with your own money, that's just going to be capital plus 3,000. And there's no specific accounts under this section. It's always just owner's capital. So I'll just leave it like this, but the assets go up by 3,000, and more specifically, which asset account? Well, cash goes up by 3,000. And then we're told that we're taking a loan, an 8% loan, an 8% $3,000 loan from the bank. And so we know that that's going to be a liability. And actually before inputting that, I just want to talk about liabilities for a sec in general. So in general, liabilities, they're going to be broken down into two categories. They're going to be current liabilities and then non-current. And the way to differentiate these two is basically current liabilities, they're short-term liabilities, while non-current are long-term. And usually the measure that differentiates between short-term and long-term is that short-term is usually going to be paid within a year, while long-term or non-current liabilities are usually going to be paid after a year or a time period that's greater than a year. And the two liability accounts that we'll deal with mostly in this particular example, the current liability account that we'll deal with mostly is accounts payable. So that will be any purchases that we make on credit. So using like a credit card. So sometimes credit card can be a separate account. It could be like credit card debt, but all those transactions I'm going to put under accounts payable. And accounts payable is a type of current liability. It's a short-term type of liability. And then in this particular transaction, this loan I'm going to treat as a non-current or a long-term liability, and I'm going to call it a loan payable. Sometimes you'll see other terms here, like long-term debt, or let's say you have a mortgage, so you'll have a mortgage payable. So any kind of long-term loans, and I'm going to treat this as a long-term loan. Now this loan you may pay off within the next year, but for the sake of this example, I'm going to treat it as a non-current liability, and it's going to be called a loan payable. So that's the account that's going to be affected. And then any short-term type of purchases, so with a credit card in this example, I'm going to treat as an accounts payable, which is a type of current liability. Right, so going back to this transaction, we have a $3,000 loan that we're getting from the bank. So that's going to be, we're going to be adding a liability of $3,000. And then again, I'm going to call it a loan payable. And then what do we get? Well, we get $3,000, a further $3,000, and that's going to be cash as well, like that. Now this interest that is charged monthly, and notice that there's an interest rate given. This interest rate, whenever they give you an interest rate on a loan, it's usually for a whole year, for an annual period. So the interest that's going to be charged on this loan is going to be 8% per year, but it's going to be charged monthly. And for now, that information in this particular transaction is irrelevant because we just got the loan. And so there hasn't been any time that's gone by. And so that interest expense hasn't been incurred yet. But later on in the example, there's going to be a transaction where we do deal with this interest. But for now, there's no interest to be inputted in the accounting system for this particular transaction because we just got the loan. So this is the only thing that would come about from this transaction. Now, this whole transaction, you could have also put in one line. So you could have brought this up over here. Like that. And then you could have just added these. They're the same account. So you would have had plus 6,000 cash. So that's another way that this transaction can be shown. It could be shown with one line like that. Moving on to the next two. So you make a Facebook business page and then start running Facebook and Instagram ads from it. And then number 3, you hire a cleaning lady to help you out with every home, and you'll pay her $20 per hour in cash. Now, these two here, they're actually not transactions. They're actually just events. So just in general, these 13 things that are listed out, you want to actually consider them events. Even though I mentioned before that they were transactions, they're all events, and then you want to figure out whether they are transactions. And then if they are transactions, then they get inputted into this accounting system. And in order for it to be a transaction, it has to be measurable and realized. So not just one of the two, it has to be both of them. So there's an and here in order for it to be a transaction. If it's only one of them or none of them, basically not both of them, then it's just an event and it doesn't get inputted into the system. There's no entry. And so measurable means that there's an actual dollar value attached to the event. And then realized, basically there's some kind of exchange that happened. Right? So if you provide revenue, or if you provide services for someone, and then they give you cash, a certain amount of cash, there's a certain amount of dollar value there, and the exchanges happen. So you provided the service, and then you received the cash, you received the revenue. And notice here, if we take this and then apply it to these two events, you make a Facebook business page and start running Facebook and Instagram ads from it. So notice in that description, there's no dollar value given. You just made a Facebook page, right? You didn't pay someone to make it for you. You made it. There's no fee involved in terms of making the page, and then you start running Facebook and Instagram ads from it. Even though you got to pay for those ads, that expense hasn't been incurred yet because you just started running those ads, right? So that there wouldn't be a transaction. It's just an event, and so it doesn't get inputted. There's no entry. Then number 3, you hire a cleaning lady to help you out with every home, and you'll pay her $20 per hour in cash. So notice that there is a dollar value in this case, but notice that there's no services that have been rendered yet. It hasn't said that you've cleaned any homes yet. So this, there's been no transaction that's been realized. There's no exchange that's happened. And so in this case, you just hired the lady. You haven't paid her anything yet. It's just stating that you're going to pay her once you are cleaning the homes. She's going to help you out, and it's going to be $20 per hour in cash, right? So that's not a transaction. There's no exchange that happened, and so it's just an event, and so there's no entry.